But hey, thanks to everyone who's joined so far, and I'm sure we'll get a few more join in the first few minutes as we kick off. The topic we're going to run through today, hopefully it's not a surprise, but it's all about tax planning and the lead up to 30 June that we've got this year. Now, this year there's definitely a number of things that we sort of haven't had in the last few years where we do this year. There's a few sort of changes, and my suspicion is there may be even more changes with the federal budget being released in May this year. But before we get into all that stuff, I might just give a heads up to the next couple of webinars we've got coming up. This first one, if you're my age, as in your 30s or older, you might remember the TV show The Price is Right. But the next webinar, which is actually next Friday, is all about navigating high inflation in business. Now, this can be a pain if we don't manage our businesses and our finances well when we've got high inflation. But just some of the things we'll be talking about is why profit might be slowly eroding. And you may not have actually noticed that, at least yet. The critical reasons why every business should be increasing their prices. And then the practical steps you can actually take to increase prices with customers. So that'll be a discussion around everything pricing and also like just sort of seeing what the effect of inflation can be on your business. So yeah, I'm really looking forward to that one. That's close to my heart and
so relevant as well, this one.
Yes, absolutely. Super relevant because I think we've had a couple of years of above average, which can compound. All right. The webinar after that, so this is on the 10th of May. The budget is being released on the evening of the 9th of May. But by the following lunchtime, I'll be jumping on a webinar with myself and Riz. And we usually do a budget debrief. We'll be going through what's relevant for small business owners, investors, and people with self-managed super funds. So that's our frame or our lens we look at this stuff through. We will be picking that apart. Now, my perspective of this, by the way, if you do want to register for the last webinar or this one, the links are going in the chat box. So keep an eye out there. So with the budget debrief, I expect that this is actually going to be a fairly, how do I call it? It's the second Labor budget. The first budget they released was actually in October after they got in a few months earlier. Got into power, and that wasn't shaking too many things up, and I think that was on purpose. We didn't see massive change and all that sort of stuff, but we did see a few little tweaks and bits and pieces. And I think what the PR or the management side of this thing is that the bigger changes are actually going to probably come in this May budget. So I'm kind of getting ready for some significant changes and potentially things that Labor has talked about over the last decade, or I wouldn't say talked about, but maybe threatened is the word I would use. Yeah, you can tell I didn't vote for him, but anyway, we'll put that aside. But yeah, anyway, we're going to deconstruct the budget and the lens again is small business owners, investors, and SMSFs and what we need to look out for there. All righty. Cool. If it's your first webinar with us, I'll introduce myself and Gulshan in a moment, but I run an accounting firm. My name is Ben Walker. I run an accounting firm called Inspire. And one of the things we're fairly well known for is saving our clients a heap of tax. And that's, a fair bit of the topic we're going to be chatting about this morning. The tally at the moment is $23 million and counting. Yeah, it's a fair few. And in this season we're in, the April, May, June of every single financial year is where we normally see that tally go up, and it may jolt up by a couple of mil, I would imagine, through the next few months. And if you are a person who's sort of exploring us or, considering looking at another accountant option for your business, then feel free to have there's no obligation, but a free 20-minute strategy call with one of our accounting team and sort of run through sort of where you're at. The purpose of that is to suss out if we're a good fit for each other and identify sort of next steps to be able to help. But if that is what you're looking for, the link is in the chat box for that. And feel free to book in. And that could also be to debrief some of the stuff we've talked about in the webinar as well. All right, next one. The other thing as well, this is not necessarily tax related, but definitely where we sort of take a look at the personal finance side of things. I published a book called Wealth for Life last year, and it's specifically written for business owners, and it's a 9-step guide on creating wealth for your family as a business owner. So if you do want to check that out, the link is in the chat box again for that one. And then who am I? So again, I recognize quite a few names in the call, but if you don't know who I am, my name is Ben Walker. I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with, I think it's actually a little bit more than 13 years experience now, and the author of Wealth for Life. And here's some of the important people in my life, the cute babies, including our now 6-month-old Poppy. Oh, so cute. And I am joined by Gulshan. Welcome, Gulshan.
Thanks, Ben. Hey, everyone. Morning. Thanks, everybody, for joining. Just thought I'd introduce myself as well. My name is Gulshan. I'm a speaker, chartered accountant now, and a senior manager here at Inspire as well. I joined Inspire in 18 as an intern, and pretty much gone through all the stages here at Inspire, and now I'm a senior manager. I have a team of my own as well. Something I'm really proud of, and this is one of the most important season, as I like to call it, for accountants, is helping clients save tax. So in 2022, we managed to save, my team managed to save around 1.3 million in tax for our clients, or our portfolio of clients, which has been massive, and just good to know that we're making an impact on our clients' wealth.
Awesome. All righty. Thanks, Gulshan. And so Gulshan and I are going to sort of share on different topics today. We'll sort of co-present the workshop, but the things we're actually going to cover is some overview on sort of how to maximize your tax savings legally. So an overview of the tax planning process, and then some key things such as the ATO's attack. That's a bit of an aggressive word, but I think it's appropriate, on trust distributions and why that's important to make sure you get right this year. The accounting lingo and the thing what we refer to this as is Section 100A. That's a reference to a legislation that the ATO have kind of changed their position on sort of 40 years later. Good on them. And the next one here is the updated guidance for services businesses called professional firm profits. So this is relevant if you're in a professional services business. Sometimes they're called knowledge workers. Doesn't sound like a great name, but anyway, like consultants, marketing, legal, accounting, IT, that sort of professional services. So there's some changes that have happened there, which we'll run through. And then we've got time at the end for some Q&A with us as well. So that's a bit of the overview of the webinar. So what I might get started with, Gulshan, did you want to sort of walk us through what is tax planning?
Yeah. In my opinion, tax planning is the most exciting time for accountants. I like to nerd out on all the things that are happening, in this environment. But tax planning essentially, guys, is this quarter that we go through just before the end of financial year, which is March to June, where we estimate what is your business going to look like when you finish the financial year. So what is the estimated profit going to look like? And what is the estimated tax that you'll pay across the group? Just understanding and knowing in advance, we think is pretty powerful. We don't like to give our clients surprises, so we do this tax planning every year with them. What we also do is during this process, what we call tax planning, we like to advise and decide on strategies that we can implement now to save money on tax. Some strategies are very time critical. We're going to discuss a few of them today as well. So if you haven't done this before, or if you're not talking about tax planning, then you're probably missing boat on a few strategies. So that's what we do just before the end of financial year. And the biggest thing is implementation. There's no point gaining all the knowledge and not actually implementing it. So you have to implement a few strategies just before the end of financial year to be able to utilize them as well. So that's tax planning. And as I said, I think it's quite valuable for anyone in business or business to go through this process, because it can be significant amounts of money saved and put back in your pocket.
Fantastic. And so just to sort of illustrate what that might look like, you pay tax on what we call taxable income. I've called it taxable profit here because I think it's a better word for it. So we don't pay tax on our income, which could be confused as sales, but it's on the profit, of course. And then let's say in an example, we've got a client who's earned 300 grand in taxable profit. Therefore, the tax, let's say ballpark, is 75 grand for that family group. There's different strategies we can apply. If they've got trusts, we can distribute through other family members or entities, or they might want to make decisions around purchasing different things, assets, for instance, that might reduce our taxable profit. So if our taxable profit reduces, then our tax payable would also, in most cases, reduce as well. So that's how we sort of calculate the value of the tax planning process, is what a client would have paid otherwise versus after the strategies, after we sort of go through and work through with them what action points they're going to do pre-30 June, and us, because some of it is us working through our magic of where the income goes. Then here's the amount you'll pay at the end of it. So, and that's an estimated tax figure that the client will pay, let's say in March to May the following year, after the financial year ends. So that's the sort of, Gulshan hinted to that lack of surprises. We want our clients to have a ballpark of what they're going to be paying in tax by 9 months away.
And just something I'd like to point out there, Ben, is you might have heard a lot of people talking about, to reduce my taxable income, I just have to spend a lot of money. Not every strategy is like that. So that's very important. You necessarily don't have to spend money on every strategy. So there are so many strategies that we can utilize to reduce that tax, rather than just spending money and buying things.
Yeah, absolutely. Awesome. And the key with this is take action before 30 June. In fact, that doesn't mean the 29th of June, by the way. What I encourage you to do is, if you don't normally do tax planning, talk with your accountant if they offer that service, or change to an accountant who does. But make sure you start that process now, because there's work that goes into actually the outcome and the process. So make sure you start having these conversations now, because we don't want to leave it till mid or late June before we go, oh yeah, that's right, I need to make some decisions and go through the process as well. So please make it an action point if that is relevant for you. If you're a client joining, because there are a couple of clients on here, we have already started that process for all our clients. So you would have got an email, or you're about to receive an email for the start of that process for you. Awesome. So we're going to go through some time critical tax saving strategies, and also some things that have changed this financial year due to budgets or rules, or previously announced changes. And the first one I'm going to go through is a time critical one. This is not a new one, but I think it's an easily missed one, which is writing off bad debts. So the rule here is you must make a decision by 30 June to write off a debt to be able to claim that as a expense. If you wait till your accounts are done, September, October, November, that sort of range, and then let's say the accountant says, hey, are any of these debts you're owed at 30 June bad? And you say, yeah, they are, but because you haven't written them off, I know this sounds a bit lame, written them off by 30 June, then technically we shouldn't be taking them out in the previous financial year. So we can claim them when they're written off at the moment they're written off. So if you've got a debt from a year ago that's not written off yet, do it now, or do it before 30 June to be able to get that deduction in the current financial year. So it's a small one, but the way you'd check this is if you use Xero, go and have a look at the accounts receivable report, and it, it'll be different for different businesses, but make sure you sort of run your eyes through all those debts. You can also run the report by age of the debt. So it shows, let's say debt's older than 90 days. That's a bit of a red flag, easy in that column for debts that might be going bad. All right. And the next one. Oh, yeah, sure.
Sorry, just on that, what it also does, it cleans up your balance sheet. So if you know that you've done everything and tried everything to recover a debt, and you know that unfortunately the customer is not going to pay, then it's better to not have that existing on your balance sheet as well.
Perfect. All righty. Would you like to walk us through the things to consider here?
Sure. So super fund is something, it's a big tax saving strategy, but also something that works for your retirement. And it's like a wealth planning strategy as well. So just before the end of financial year, what we walk through walk all of our clients through is how much of a super contribution cap do you have existing? Now, I think the ATO started this in 2018. Every year you get a cap of, now it's $27,500. It used to be $25,000 that you can contribute into your super fund and claim it as a tax deduction. Now, what they started in 18 is if you haven't utilized that cap to the maximum 27,500, then the unutilized portion you can carry forward to the next financial year. So if you're a business owner who hasn't looked at paying super in the last 2-3 years, then you might see that you have a lot of cap remaining. What you can do is, if you've had a really profitable year this year, you can put a lot of money into your super fund and claim it as a tax deduction outside of your super. That's a really good strategy. A lot of people ask us that, hey, that money is going to be locked away. What will I do? That is an answer specific to you. What do you plan to do with that money? You can start an SMSF. You can buy property. There's heaps of options that open up while you put money into the super fund. It's not just that. Yes, you can't access that money for your personal use, but you can definitely do something with it. And also the other side of the benefit is that tax advantage of, as Ben started with, that reducing of taxable income. So let's say you put $75,000, just as an example, into your super fund, your taxable income reduces from 300 to 225 in that example. So it's pretty big, and it can save you a lot of money.
Yeah, and how much you've got remaining to contribute and things like that. That's what you need to look through with someone like an accountant who can actually sort of check those numbers. And the ATO has some of that data reported by your existing super funds, or if you've got it in SMSF, that's quite easy for us to check. But yeah, all of this is the idea. Obviously, don't just go and chuck 100 Rand into super and think, oh yeah, I get a deduction. There's things we need to make sure you qualify for. And as Gulshan said, some clients actually have an aversion to super. That's fine, but the other perspective is the way I think about it is it's a low tax environment. At least Labor not changing the rules too much on it, but you're compounding your wealth at probably half the tax rate you would pay outside of super. So over 20, 30, 40 years, the difference that the tax rate will make on your investment earnings will add up to probably hundreds of thousands over your lifetime. So it is a great thing. Clients who can already access super, most clients could still probably put money into super as well. So if you're over 60 and retired, or over 65, and again, there's conditions to meet, but if you meet those things, some of our clients can put their cash in as a contribution and be able to take it out the next day. So that's pretty cool. Anyway, so again, this is a very detailed one. Please do with advice.
Absolutely.
Cool.
And there's forms and stuff that need to be lodged as well. So there's lots of stuff to go through before you do it, as Ben mentioned. So please reach out before you do it.
Awesome. Alrighty. Now, this one's a bit of a topical one. This is a budget change, which I think was announced in October last year, if I'm not mistaken. Yep.
Yeah.
And it's around an FBT exemption on EVs. Now, I like my V8s, so I'm going to let Gulshan run through.
I like electric vehicles, so I can run through this one.
There we go. Now, do you want the table, or you let me know when you want the table?
Yeah, cool. So basically what the government is trying to encourage is uptake of electric vehicles by using this strategy. What they want is more people buying electric vehicles. So what the strategy basically is, if you buy an electric vehicle before the end of financial year this year, then you can claim, obviously that's one part. So you can claim it as a tax reduction in your business. But earlier what used to happen is you used to have a logbook. So you can only claim the business use of that car. So you can, let's say your logbook had 50% business use, 50% private use. You can only ever claim 50% of the car. But what's happening with electric vehicles is, regardless of what that percentage use is, so even if it's 50% personal use and 50% is the business use, you can claim 100% of it still. So that's the benefit. It's really beneficial for professional people who don't travel much, and usually have less of that logbook percentage and are able to claim really less of their cars anyway. So for those businesses, this strategy is going to really, amplify what you can claim and the amount that you can claim as well. Now, there are obviously some catches to it. Ben, if you can go to the next one.
Yep.
There are things to think about, but if we were to compare the cost of this electric vehicle with the exemption and no exemption, you guys can see the difference. So let's, for assumption, we've just taken a Tesla that's worth 77 grand with exemption and no exemption. So with exemption, you get the GST benefit of 100%, basically, and that's capped to the car limit. So I think the car limit this year is around 67 or 64 something $1,000. So you get 5,800 back as a GST refund. And you also get the tax deduction of 25% of the car limit as well. So that's $14,000. Now, normally you would have to pay FBT on that for that personal use, basically. So if you look at the no exemption section, there's an FBT calculation. Basically, there's a formula that the ATO gives that how you calculate the FBT percentage. So that's 20% of the cost, and there's a multiplier there. So in terms of FBT, you will pay $15,000 back of that deduction that you've claimed for the cost of the car. You will pay $15,000 back. So essentially, it's trying to reduce what you can claim for the cost of the car. Obviously, you do get a bit of tax deduction on the FBT that you pay, which is the 25%. So you can see the difference on the actual cash spend after the benefits that you get is around $11,291 based on the cost of this $77,000 car. So that's massive for someone who's never been able to utilize, much motor vehicle expenses. You can claim quite a big expense and reduce the cost of the car upfront for the business. This is from a business perspective. If you're doing this for your employees, there's benefits as well for the employee as well. So all in all, it's massive. I've been pretty excited with this strategy, especially for clients who were already in the process of buying. I've had clients, at least 4 or 5 clients who were already in the process of buying a car and are like, use this strategy. It's going to be a game changer. And, they've managed to save around $10,000 to $15,000 in tax because of that. Again, something to really note is the temporary expensing or claiming the whole cost of the car is going to finish on 30th of June, 2023. So there's 2 strategies talking to each other in this one. So you got to make sure that if you want to apply that whole strategy, then you buy it before the 30th of June. If you can't, then the old rules will come back into the picture and you can't deduct. During COVID, we were deducting the whole cost of the asset. That's going to stop from 30th of June 2023.
Yeah.
So it's a bit of a time critical one as well.
Yeah, and just to add there, so 30th of June 2023 is when the current full expensing finishes, and I'll say unless our current government extend that, but I'm not going to hold my breath on that one. The other thing to keep in mind with cars and purchasing them around this time of year is that you need to take delivery of them by 30 June to be able to claim them in that financial year. So you might be able to get an invoice from the car dealership pre 30 June, but it's the delivery. And I know that, ordering cars at the moment, some cars take, 18 months, 2 years, even 3 years, I heard, for certain vehicles. But so we've got to make sure, if this is a part of your tax planning strategy for this year, you need to reasonably expect to take delivery by 30 June. So keep that in mind. And again, that's something else to not leave till the month of June to find that out. Awesome. All right. Switching gears. And the next strategy here is the Small Business Investment Technology Boost. So this was a COVID measure announced in a previous budget, not the October one. It would have been one before that. But the idea of it was your businesses are able to claim an extra 20% on expenses that support digital operations and digitizing operations. Now, from my perspective, I think the incentive here was, hey, we've got COVID, we've got lockdowns, blah, 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 blah. Let's encourage businesses to spend money to be able to operate online, digitize. So things like digital payment systems, subscriptions that help digitization, which, I feel these are quite broad, which is great. Digital media and marketing, audio and visual content that can be created, accessed, stored, or viewed. This is pretty cool. So video production, it's cool. E-commerce, supporting digitally ordered or platform-enabled online transactions. So there's a few different categories here. The idea here is that you claim an extra 20% as a tax deduction. So let's say you spend 100 grand. I think that's actually the limit.
That's limit for this one. Mm-hmm.
So normally if you spend 100 grand on this stuff, business related, this stuff, you get 25 grand-ish deduction. What this is saying is we add another 20% of the 100 grand to that claim. So now we get a 45 grand deduction, which is a, is that how it works?
No, sorry. So basically if you've spent $100, you'll be able to claim a deduction on $120. So you'll be able to claim 25% on 120 rather than 100.
Cool. So it increases the actual tax deduction by 20%, not the whole, a lot,
Correct.
Another 20%. Yep. Cool.
Yeah.
So it's a fantastic, I think it's a fantastic one. Now, I feel like this is going to be an easy one to miss. So again, if you've spent money on this stuff, and there's a very similar one coming on the next slide, then please make sure your accountant is dealing with this stuff. We've got this stuff built into checklists, and it'd be hard, obviously, for us to miss. We're presenting on it. The other one as well that they announced in COVID operates very similar. So it's an additional 20% tax deduction for skills and training. So the eligibility, I'm going to check that you qualify for this, but it's small business, employee is Australia based, and the course is provided by a registered provider. Just make sure not only you as an entity qualify, but also with the money you're spending it on. Things like certificate 3s and 4s, grad diplomas, that sort of stuff will be covered. So and again, if your bookkeeping is done well for this, obviously for this financial year, and you've got this stuff in a pretty obvious account, training and that sort of thing, that's where you want to have these discussions with your accountant to make sure they're picked up. Same with your digital marketing and digitization. So make sure that is fairly obvious. So and any more thoughts there, Gulshan, on those?
Yes. Something to note, first of all, on both of these is they are not law yet. They're still draft legislations, but they will. We're thinking ATO has already published this on their website, so they are very highly likely to be law. both of them. So it's important that we start discussing them. Now, with the skills and training boost, there's no cap. So you can claim how much ever you want. There's no cap on that, provided the course is through a registered provider. Now, Ben mentioned certificate fours and, all of that, but like, let's say you're doing an RTO registered course for upskilling your employees, those sort of courses are also included. So it can be pretty massive, especially for someone who has a lot of employees.
Yeah.
So,
and I think things like some of our clients got the BAC grant, the BAC grant, which was another COVID measure, and a requirement of that is you pay for an RTO qualified course. So I feel like maybe we're getting another sugar hit there of a tax deduction, which is good.
Yeah. Crystal just asked, how about professional development courses with accounting professional bodies? So Crystal, to answer your question, I'm not 100% sure of which body is considered as a registered provider. There's a list that they've given, but we can obviously check that if you wanted us to, and we can advise on that.
Cool. All righty. All right. Cool, Sean. Take us through the Section 100A
changes in trust distributions. I feel like this thing has been talked about so much the last couple of years. ATO is doing this, ATO is doing that. And how I look at any law, first of all, is what is the intent, right? So the intent of 100A or Section 100A is the economic benefit of the distribution should be enjoyed that by the person who is receiving it. So basically what that means is, what used to happen is you could distribute to your family members and it was just an on-paper distribution, or the money never used to transfer hands, or the money never used to go to them. So it was just the incentive of the distribution was to reduce the overall tax that the family would pay, right? Now,
this is what they're wanting to stop.
Yeah, so that is what the ATO is trying to stop. Basically, what they want.
Blatant, by the way. Sorry to interrupt, but that's a blatant example that they wanted to stop. On paper, no money transferred.
Yeah, and what they're trying to stop is what they're trying to encourage, if you're distributing to a family member, then the money should go to them, and they should be the one who's using that money for economic benefits. Now, it's not super straightforward. Obviously, there's so many examples with this, but what we've done is we've listed the main kind of 3 examples. So if you're a family business and you're distributing to your spouse, that's generally okay, because let's say you're distributing the money to a joint account and you spend all the income that you get anyway together. So that's fine. And that's still in that green section. It's a traffic light kind of test. The ATO has green, red, and amber. So green, amber, and red. So if you're in the green, then that's fine. And you and your spouse is generally in the green. Now, adult children, if you're distributing money to adult children, it's the same. If the money goes to them, then it's fine. Or if they're boarding with you, so if they're staying with you and you anyway give them money to, live their life. Children cost a lot of money these days. So sometimes parents support them, by just giving them some money. If you're anyway giving them money, what you can do is then you can distribute that money through your business instead, and that's fine. But if the idea of the whole distribution was just to, reduce your tax, then that's going to be a no again. So you have to be very careful on what the reason is and what sort of arrangement do you have with your children as well.
So we start falling into a bit of a grey area and a little bit of he said, she said with this stuff. And I feel like there's genuine arrangements where, we've got plenty of clients where let's say there's 2 or 3 generations involved in generating wealth for the family. They might pool their wealth into a trust to invest in, property or different things, whatever it is. And then the trust distributions could go to, let's say, up to 3 generations of that family. Situations like that are going to be quite difficult if the ATO go and audit that sort of thing to say, like, why is that not legitimate? So again, that's I feel falls in the grey area. Blatant examples are, let's say you've got parents that you sort of flick 100 grand each on paper, pay their tax bill, and they never get the economic benefit. That's a pretty blatant example, and something that we actually wouldn't advocate even before they've sort of clarified their position here on these trust distributions. But it's a bit of a fun one, and this is new. So as in a new position the ATO has taken to be sort of so specific with their examples and that sort of thing. So for any accountant, this is sort of the first year we're sort of heading into this territory, and there'll be conversations that clients definitely won't appreciate because, hey, for the last 20 years we've been operating like this, and then now we've got to, we kind of do, we've got to be careful. So
and also I think just to add there, Ben, this law has already in place for a lot of years. It's just that the ATO's never enforced it with all these examples and what they're actually looking at. So it's just clarifying what the ATO's stance is, and then we have to apply that, going forward as well. Just to add, with the adult children, there's parents. So we've spoken about adult children, spouses, but there's also parents or in-laws. Again, very similar concept that you cannot be just paying them money and they gift that money back to you because they don't need that money or they're retired or whatever. That is also not allowed.
Yeah, or the old, distribute them 20 grand and then wink, wink, give it back. That's not going to cut it. We've got a couple of questions. Sharon's asked, so now you need to physically transfer the distribution to spouses and children. Spouses, I feel, we kind of feel is fine. The money would generally go into joint accounts or, spouses is not the issue with the ATO. It's more children or other relatives where they're in a low tax bracket or lower than, let's say, you and your spouse, and there seems to be potentially a tax benefit there. So this is the grey thing. It's like, well, is it primarily driven by a tax saving, or is it a relatively normal arrangement with a family who's building wealth together? That's going to be the fun one to try to communicate to our good friends.
And at the end of the day, if there is an audit, it's a matter of what is your stance on why you did it. If you have a proper explanation of, this is our family dealing that's been like that for the last 10 years, and this is why we're doing it, and it's probably going to cut it. But if not, then it's going to be hard.
That's it. Brendan's asked, what about distributions to siblings? Absolutely. So they will be scrutinized as well. So let's say I distribute I've got a sister. Again, economic benefit needs to go to her. So if I distribute 20 grand on paper, cool, 20 grand goes into her account, and no wink, wink, nudge, nudge reimbursements. that is the examples they give. All righty.
We've got some other questions as well, Ben, in the Q&A. So I don't know if you want to take them now or later.
I've tried to address the ones around the distribution stuff. I can't see any others.
It's in the Q&A, not in the chat.
Thank you. Yvonne, hey, retrospective for how many years for super? So that's from the 20, sorry, this is, hang on. I might park these because these are not the distribution related, they're previous strategies. So we'll run through them in the Q&A, which we are not far away from. So I might go through that then. Alrighty, the allocation of professional firm profits. So this is this is another interesting thing. I disagree with this set of rules more than the trust distribution stuff. The trust distribution stuff I can kind of say, some people take the piss, but this is frustrating and I feel it's unfair on certain industries. So the industries that this affects is if you're in a service-based business where you're selling knowledge or selling expertise. This is not relevant for a pool shop where you're selling creepy crawlies and different things for pools, chemicals, or manufacturing. It doesn't affect this. It's more professional service-based firms. And maybe I'm a bit biased. I don't like it because it applies to me too. But anyway, so what they're trying to do here is basically, if you use a trust or a company to run your service-based business, they want to attribute as much money as they can in the expert's name, if that makes sense. So, and this is for owners. So let's say I run Inspire. They want basically the majority of the profit, or here's how it works. The more profit that ends up in my personal name and me taxed at a higher rate, the less risk the ATO deems I'm potentially breaking these rules, or the intent of these rules. Now, this is a weird set of rules. There's no black and white with this. They've given literally a traffic light system of how we determine if we're low risk, medium risk, or high risk. This is just a nightmare. But again, things that make it less risky for the ATO is most of the income from your company or trust ending up in your name. That's taxable income. Rather than being distributed across family members or into a bucket company, things like that. But there are parameters they give. So what ends up in a red box is pretty clear. What ends up in an orange or a green box, they give effective tax rates across the family group, or percentage of income paid as a market salary, things like that, to reduce our risk. So it doesn't mean 100% of your business's profit needs to end up in your own name, even though that's, I'm sure, what they'd love. But we need to find the balance that we sort of see is fair, where we sort of sit within these rules. And again, this is a process through tax planning we need to go through with every service-based or professional firm-based client, where we're looking at these traffic light things and making some judgment calls and documenting where we feel we sit and why.
Yeah, and documenting it is pretty important, just so if there is an audit, then we can explain why we did what we did, and like what was the rationale behind it. And just as an unbiased opinion, I think yes, this strategy is a bit more what's the word? Anyhow, I'm losing the word, but this is applicable for professional firm or professional service-based businesses, but there's so many things that the accountant can sit with you and discuss with you. It's not like super straightforward, black and white, as Ben mentioned. So it's really important to work through this stuff, not blatantly just distribute everything to you or most of it to that IPP or the main person. But there are still things that you can, reduce your income but still be in the green zone or the amber zone, or whatever you would like. So there's a lot of things to work with.
All righty. Okay. Well, now we're going to shift gears. We've sort of finished the strategies. I just want to give a final reminder of a couple of things. The first one is if you're not currently doing tax planning, start it now. Talk with your accountant if they offer that service. Good. Otherwise, talk with another accountant who can offer you that service, because I think being prepared is a better outcome than being unprepared. The other one is, if you do want to have a chat with us, then feel free to book in for a strategy call with one of our accounting team. The link will be in the chat box in a moment. If you do want to sort of have a chat about some of these strategies we might have talked about, or again, want to explore what it looks like working with us. Cool. We're going to shift into Q&A. We've got 3 questions already, but feel free, if you do have additional ones, then feel free to pop them in the chat box or the Q&A box now that we've got that open too. All righty. So Yvonne, your question is with the super contributions, retrospective for how many years? Now, I'm fairly certain that this is the 2018-19 financial year. Any unused concessional contributions can roll forward. Now, there is a catch. You've got to have a balance of less than $500,000 in super as well. So yeah, we just need to be mindful again. With these strategies, there's asterisks everywhere. So yeah, it's quite easy for us to work with you on that one if you want some guidance on that. Alrighty, Howard. So the small business SBIT,
Small Business Investment and Technology Boost.
this one here, cool. So this one here would effectively cover all IT costs. I would say no, that's not necessarily it shouldn't necessarily cover all of them, but the goal would be to read the frame of the rules and then work through the different subscriptions of whether or not they would fit into that category or not. So I don't think we can be as overarching as everything technology related. So it'd be important to look at the rules and then, yeah, case by case, unfortunately, and as tedious as that is. Alrighty, Karen, this is related to this one, was in effect for the 22 financial year as well. Now, Sean, I saw something on this.
Yeah, I think the law came, it hasn't come into effect yet, but if it will retrospectively apply from 29th of March 2022, but we will be able to take that part in 2023 financial year. So you don't have to go back and amend tax returns for that, Karen, but we can take the expenses from that period into this calculation as well. Good question.
Cool. Alrighty. Abdul has asked a question on the saving if we compare purchasing an EV versus a normal vehicle. Here we go. Where are the extra points of difference if they both cost 77K? So maybe I'm not sure. This is sort of this diagram here, but the point is this FBT difference here, where without the FBT exemption, we're paying fringe benefits tax on the private portion. And because we pay FBT, we can actually get a tax deduction on the FBT we pay. So it's not a net cost of 15K. The net is about, it's down here, 11,291. So again,
that's the difference.
That's a guide.
Yeah.
Cool. Sweet. So Michael's asked a question. Can you touch on the benefits of investing in property? It's not quite the purpose of this webinar, but we've definitely got a lot of content on that. So Michael, we might link up separately some guidance around property and the tax outcome there, if that's okay. Cool. Alrighty. Well, hey, that's the sort of all the sort of questions I can see at the moment. But we might sort of wrap up there.
Just one thing before we let everyone go. This list was mostly talking about the new strategies that have come about,
Yes.
after the budgets and stuff. By no means this list is exhaustive. There are so many more strategies that need to be implemented or should be implemented in your businesses. So pretty important to do tax planning with your advisor or your accountant.
Awesome. Yeah, good reminder, Gulshan. And just one final thing before we sign off and I put another 80s track on, is if you do want to join us at our next webinar, that is literally a week from now, which is called The Price is Right, and Navigating High Inflation in Business is the topic. So we're talking about all things dealing with inflation, looking at profitability and how we might adjust our price as a result. So feel free to come along to that if it's of relevance and interest.